Ian, how do the changes in world fixed income markets and central bank actions play a role in the South African fixed income market?
Let's start with the Fed. Fed sets the base rates in the world. What are we seeing at the moment that the market is expecting? Well, the market is expecting the Fed to probably remain on hold for a very long period of time, maybe for the next 2 years. Rates in the US are going nowhere. Remember this, the Fed cut the rates to 25 basis points. They are going to increase the balance sheet exponentially. They're buying assets in the market. This is quite important for the base rate in the world. Global interest rates aren't really going anywhere. We've seen it with the ECB and all the major central banks. Just for interest sake, the rate cut that we saw in April was the 100th rate cut by a central bank in 2020. That is amazing stuff. Right, to move on. So yes, March was very painful for all of us. What happened? March was not a repeat of 2008. 2008 was what we call a solvency event. Valuations just got too expensive. March 2020 was a liquidity event. We saw that even the US bond market became illiquid. The South African bond market became illiquid. It's a very, very different environment than what we've seen. It's not the same as 2008. When liquidity moves away from markets, prices fell, and that's why it fell so rapidly. So if we move to the US yield curve, what happened? So the Fed cut rates to 25 basis points, and they said, look, they're going to buy all sorts of bonds and credits to help support liquidity in the market. It's quite important. What happened to the US Fed curve is what we call a bull steepness. So the short end moved a lot more than the longer end. Why? Because the Fed cut rates so aggressively. If we then move to the expectations of what does the market expect of inflation and growth in the US, you'd see what we call the five-year forward break-even. It actually measures where the market thinks average inflation will be over the next 5 years in the US. So just to give you an idea, we've been in a low inflation environment now for quite a while, and in the US, the average inflation has probably been around 1.6. Over the next 5 years, the market expects inflation to be less than 1.5 in the US, probably a lot lower than this year. So it says to you, there's not a lot of inflation expected in the US. It's good for bonds. Remember, low inflation is good for bonds. If we look at the high yield curve, now this is where non-investment grade corporates trade in US dollars. At one stage in 2018, they traded at a premium to US treasuries. Have you ever heard credits trading at a premium to governments? That just does not make sense. What we've seen in March was what we call a derating. Spreads widened significantly, making them a lot cheaper versus US treasuries. So now we think credits in the US are priced a lot more attractively than where they were. If we move across the Atlantic Ocean to Europe, what's happening in Europe? Well, in Europe, we know that the ECB cut rates a little bit further, but remember they are negative. But the main important instrument they use is going to be buying more government bonds in Europe. They're even going to buy Italian bonds, can you believe it? Which will mean that what we call a curve bull flattened. The long end of the curve moved a lot more than the short end of the curve. What does that say to you? It says that it's a good environment for bonds. The bond market in Europe is not concerned around inflation and is very concerned around growth in that market. So are we surprised when the ECB comes out and says, we'll do what it takes, what's necessary? These are important words from central banks when we hear them. So most developed market bonds have obviously rallied very hard, but what have we seen in emerging markets? Well, in emerging market yields, they've shot up. Think about it, the 10 years moved from around 9% to 12.5%. That's massive, it's 350 basis points. And we've seen it across EMs. Why? Because liquidity went out of markets. There was fear in markets. Get out of EM and get into developed markets again. We think South Africa took an inordinate amount of pain. We look like Turkey, yet Turkey is rated 2 notches below us, even after junk. So we think because the South African market is liquid, we took a lot of pain. Foreigners just wanted to get out of South African assets, and that's what happened. Our bonds are very, very cheap in relation to emerging market yields and in global yields.
We've seen the ratings downgrade and all the negative news around the economy. Is there an awful down scenario for South African bonds?
So if we look at our own yield curve, remember a yield curve is a term structure of South African interest rates. Our curve is very, very steep. So I said to you, in developed markets, the curve flattened. In South Africa, a curve steepened. What does it mean? It means short end rates rallied a lot more and high end yields, the longer end yields actually went up. So that we at the moment have a 3% gap widening between, let's say, a 10 or 5-year bond and a 30-year bond. There's about 300 basis points. Now that curve is way too steep. It's worse than 2008, and it happened over a very short period of time. So if we look at our sovereign spread, what we call our CDS spread, so basically where South African debt trades in dollars, we've seen that that spread has probably moved in excess of 400 basis points. We look even worse than Turkey, and as I said, Turkey is worse rated than South Africa. So we've seen an important amount of South African selling of our dollar debt, which we think is not warranted given our fundamentals. So what does it mean for local markets? So if we move to the South African money market, I think it's quite important that we also see that our money market curve is steep. Well, firstly, why? Because the SARB has been cutting rates. We've seen 225 basis points of rate cuts so far. That's shortening the curve. And obviously, in the long end of the curve, banks are still incentivized to fund their deposit base longer, so they pay up for longer-term funding. So that's why South Africa's got a very steep curve. And we think that's a big opportunity in the South African cash market for investors that wants to be conservative and put their money into cash. Now moving to the bond market, and yes, it's the sovereign downgrade, and there will be hundreds of billions of rand flowing out of South Africa when we get jumped and will fall out of the weekly index. Well, we've seen it. We've seen foreigners now net sellers to the tune of about 60 odd billion of South African bonds year to date, not the hundreds of billions. And yes, the foreigners have probably moved from being holders of about 37% of South African government bonds to around 32, 33% as we've seen. But remember, these market events are well priced. So the market was already preempting that there would be a selling. And everybody said, well, you know, the end of April is going to be disaster in the South African bond market. Well, we haven't seen it. In fact, in the last week of April, foreigners were net buyers about 4 billion of South African bonds. So it says to you, a lot of these market events are actually well anticipated and well priced. So if we move to the South African yield curve, we can see it's very steep. As I said to you, the 5-year to the 30 is 300 basis points. We think it's too excessively priced for negative risk. What do I mean? I mean, in that steep yield curve, it already says, well, we know that Eskom is bad. We know that government finances are bad. We know that South Africa is not going to grow. There's going to be a big budget deficit. But that's too steep. Because let's put it in terms of the reality of South Africa. So we believe that the economy could probably shrink about 5% this year, and inflation could be lower than 3%. Now, if you say, well, inflation is 3% and the 10-year yield is 10.5%, well, that's 7.5% real. That's equity-like real yields for bond risk. And that's why we think South African bonds look very attractive for investors at this point in time. So if we look at our fair value, and we always say, well, where do we think our fair value should be? And we get to around a 10.5%. Currently, we think that's probably at fair levels, but these are the curves. These aren't our own forecasts. So it says to you the market is basically pricing a lot of negative risk in South Africa where US treasuries have gone negative. We've put it as a zero in our model, but you can see the market is pricing for excess of 6% inflation, where we think inflation over the next 1 to 3 years could be 3, 4, maybe 5%. So if you already say, well, the market is pricing for excessive inflation, our fair values could be lower. And when fair values are lower, it means we'll get good returns out of bonds. If we now move over to inflation-linked bonds, well, what's the reason for buying inflation bonds? You want to protect your savings against the negative effect of inflation. But now I'm saying to you, there's going to be very little inflation, very little growth. Why do you want to protect your investments against inflation at the moment? We think inflation bonds are probably our least preferred asset class at this point in time. Why? Because you don't need inflation protection. Inflation is going to be 3 and lower. You're getting high real yields from nominal bonds. We think that the real yields that you get out of inflation bonds sitting at around 4.5% is too low. If at 7.5%, you're getting that high real yields from nominal bonds. So we'd rather be in nominal bonds than inflation bonds. And secondly, inflation bonds are typically also a lot more liquid, harder to trade, and the prices can be volatile in that market versus our nominal bonds. We're also seeing that demand really fluctuates, and there's issues around trading inflation bonds because you get a lot of buy and hold investors in that market. So yeah, we'd be a lot more circumspect. There's a time and a place for inflation bonds, but not an environment where you're growing at -5% inflation, sub 3%. Inflation bonds is where you buy when inflation is expected to breach 6% and the economy is going at 3 or 4%. We think that's a good environment for inflation bonds, but not at the moment. So when we talk around the credit market, sure, this has been a hard one because if you think about the South African listed credit market, it issues around 150 billion worth of credit every year. Last year, we had a massive issuance year of nearly 170 billion. This year, it was expected that we would issue around 150 billion, but down to COVID-19, issuance has basically stopped in the market now since March. We're not seeing a lot of issuance. We see that credit issuers actually come and talk to us on a bilateral basis, where they want to issue on a deal-based basis to us. So we don't expect a lot of credit issuance this year to come out. What we have seen, though, is that credit spreads widen. Now, you would have heard me in previous presentations say that we're very circumspect around the South African credit market. We were very concerned around the South African credit market. Why? Well, firstly, because credit quality is deteriorating. We're seeing a lot of companies under balance sheet stress. And secondly, the pricing of credit was not attractive to us. Now, remember, in our philosophy, pricing is very important. We want to buy assets when they go on sale, not when the market is on fire and prices are high. So what we've seen over the last 2 months or so is that spreads have widened significantly. And it started, not surprisingly, in the lower quality parts of the market. Now, when we say lower quality, we mean the more risky debt. So where was the more risky debt? What we call bank 81 debt. That's basically nearly equity type debt in the banking capital structure. Bank sub debt, so lower quality debt. We've seen those spreads probably widen over the last 2 months, about 200 to 300 basis points. Now we've seen that the spread widening has migrated up to the higher levels of credit, where bank senior debt is probably moving 80 basis points higher. Your industrial type credits are probably moving 100, 150 basis points wider. We are still waiting to see where the property companies are going to issue, because we know there's big issues there. But we think this is a great opportunity where for the last 2 years, I've been very circumspect and say, be careful when you go into credit. We think there are great opportunities in the credit market now for investors, especially looking for opportunity that's a bit above cash. You're not taking a massive amount of interest rate risk, but we think there's a good opportunity in the credit market to return high type yields without taking an excessive amount of risk. So we are getting very excited about the secondary credit market. We're seeing good quality names where the spreads have widened and the prices have fallen to pick up the opportunities. But we obviously have to be careful around what we're seeing at the moment, because credit quality is deteriorating. If you look at the graph, you can probably see when it moves up, it means that balance sheets are under fire. There's a lot more pressure coming up. And it's not going to be equal across the whole credit market. We know that there will be pockets of credit which will be okay. And we think there's pockets of credit that will come under severe stress. So, for example, we think that the property sector will feel a lot of balance sheet stress, because we know what's happened to shopping centre. There's a problem with rentals. We also are concerned around what will happen with the non-performing loans in credit retailers, as well as non-performing loans in banks. I'm not saying that banks will fall over in South Africa, please. Banks in South Africa are very well capitalized, but we have to accept that there will be more non-performing loans, and credit quality of our banking system, of our industrial sector, and especially of our property sector will be a lot worse than where they were. But this is a good environment for stock pickers like ourselves looking for good opportunities. As I always say, in investment, we're like miners. We have to sift through 10 tons of rocks to find that 1 or 2 diamonds, and that's what we do on a day-to-day basis for our investors.
All right, so Ian, we're here now. How do we monetize this fixed income opportunity to the client's benefits?
Well, we're in an environment where inflation is low, growth is low, and real yields are high. I think this is a very good opportunity to lock in high real yields for investors. There's a big tailwind in it. Why? The SAR was cut rates by 225 basis points. We're expecting another 50 to 100 basis points of rate cuts. Inflation is falling. Growth is very negative. So a lot of tailwinds for South African fixed income. I also made the prediction that South African fixed income may be the only asset class over the next 1 or 2 years that will actually give you an income. Why? Because what's happened on the equity market? Most dividend distributions have been stopped. What's happened in the property market? Most distributions from property companies or REITs have been stopped. But they have to pay us our coupons. As fixed income investors, they have to pay us our coupons on time. Otherwise, it is a default. So we believe that fixed income could be a great place in portfolios and client portfolios if you are looking for income. I think for the first time in many years, fixed income will deliver on its name of income. And I think it becomes quite important in these times to actually have income. And my last point to always say is that remember, in times of stress is when the best opportunities are found. Yes, it doesn't feel right and there's all sorts of issues around South Africa, but remember, it is already reflected in the price. When our 10-year yield trades at 10.5% and the long yields are trading nearly 12%. That says to a lot of negative things in the prices. And we always say to our clients, it's in times of these that you set yourself up for the next few years by actually investing in high quality assets at low prices that reflect all these negativities and just let the market do its work for you over the next year or two. We have to say that the valuation argument for South African fixed income is really solid. We've shown in previous slides that South African fixed income is really cheaply priced. There's real returns to be had at low risk since all the bad news are behind us. And yes, for investors looking for income, I mean that over the next 2 years, I think South African fixed income will be the only asset class delivering a income through coupons and interest rates. And how does it stack up? So how do we get to the numbers? And forecasting is tough in this environment. So let's start at the lowest risk, at cash or money market, where we believe a return around 5.5% over the next year is possible. We move a little bit up the curve. We can talk about credit. We think credit will probably give you around 6 or 6.5% return. If we move to the inflation protection market in South African inflation bonds, we think we can generate returns around 6 to 7% over the next 2 to 3 years. And then our most preferred asset class would be South African nominal bonds, where we think returns around 8.5 to 9% is really possible. Even if bonds go very little down, we will still generate a high level of coupon, which is around 8%, but we don't have to stretch the valuation to get to those return numbers. I think over the course of my presentation, I've given you a compelling argument for risk-averse investors, as well as investors looking for fixed income exposure to invest in South African fixed income through the funds. And we would really encourage you to use momentum investments as your exposure into South African fixed income. I thank you.